Hello friends, welcome back to the Pyramid Portfolio Update as of Monday, June 1st, 2026. As usual, I hope you'll find the information in this video useful, but disclaimer, please note that this is not investing advice, it's just my portfolio as it stands today and it can change at any time without previous notification. Following an investment strategy without doing the work yourself is almost guaranteed to result in losses. So please be careful since it's your responsibility to do your own research before investing. At the end of the video, in today's bonus section, we will discuss a topic that I wanted to do for a while, inflation, and why I don't believe it's a relevant metric for an investor. Now, let's start and look at this month's activity. May was a very uneventful month. I just got some altcoins from Binance and Revolut via the Learn and Earn programs and didn't buy and didn't sell anything, which is actually sticking to the main plan. I also have a big fat zero in terms of cash flow with no dividends or bond coupons whatsoever. However, early next month, some money will start coming in again from dividends and CDs. I think this is the first ever month with all three categories showing a zero in almost 5 years of portfolio tracking videos. That being said, the portfolio as of June 1st is currently looking like this. Please pause the video if you want to analyze each investment in more detail. Finally, the current pyramid portfolio allocation after May is the following. Most changes are from forex exchange rate valuation, the euro increased a little bit in relation to the RON, and automatic adjustments, meaning if something drops slightly as a percentage, others go up to fill the rest to 100%. Overall, the portfolio was stagnant, showing a small minus 0.1% decrease for the month, and it's the same year to date. Taking into consideration that almost half the year is already gone, I just paid for my living expenses so far. Now, before going to the next section, if you are interested in the subject, please leave a like and subscribe to the channel. It really helps bringing this completely free information to more and more people. As mentioned at the beginning, in today's bonus section, we will talk about a subject that I teased for a long time, and that is inflation. And I'll briefly try to explain why I don't think it is a good metric to focus on. Now that inflation is on the rise again and the new Fed chair might increase the rates instead of decreasing them, inflation has once again become the focus of investors' nightmares. A couple of years ago, I had a discussion with a friend in which I mentioned that I don't really care about inflation, since to me, at that time intuitively, it didn't mean anything. And the main problem I had was with the price of eggs. For whatever reason, there is always a psychosis about egg prices going up when inflation hits. Maybe because it's the cheapest protein source, maybe. You see articles on TV and in the media that the price of eggs is skyrocketing, and I was thinking, how many eggs should I eat in a year for me to feel the sting to my bottom line? It has to be in the thousands, which is basically impossible. So I started to dwell into inflation and try to understand why it felt to me that it was a phony number. First, let's start with a working definition. There are many, but the main idea is that inflation is the general increase in the prices of goods and services over time, which reduces the purchasing power of money. When inflation occurs, a single unit of currency buys you less than it did previously. Inflation has some key concepts. First, the purchasing power. Because prices are higher, your money doesn't stretch as far. For example, if you have $100, you will be able to buy fewer groceries today than you could a year ago. This is the easiest part to understand. The second concept is the basket of goods. Inflation refers to the overall broad increase in the cost of living, not just the price of one isolated item. It is usually measured by tracking a representative basket of goods and services. I think you can feel already that this is where the problem lies. And finally, the inflation rate. This measures how quickly prices are rising over a given period of time, usually year-on-year variation. Prices can go up for different reasons, the main one being that there is more demand than supply. there is a problem with the production of a product that people want and they start bidding up the price to be the ones that get it. Another reason is artificial scarcity when the producer is manipulating the price to value ratio. Think about luxury brands that prefer to sell less items at a continually higher price than satisfying the current demand. They usually destroy products so that their brand stays high-end and doesn't become accessible to everyone. And last but not least, the M2 money supply, which is a broad economic metric that measures the total volume of highly liquid money circulating in the economy. It includes physical currency and coins, checking accounts, and easily convertible near money assets like saving deposits, certificate of deposit, CDs, and retail money market funds. Let's assume that at a specific time, all the goods and services produced by the world economy have a value of X, 100 to $200 trillion or a crazy number like that. And the monetary mass has a value of N times X, meaning everything has a price that is relatively stable. Like in our egg example, the egg is 25 cents or whatever price it is an egg today. When the M2 money supply goes up, for example, when central banks are printing new money, the total volume of goods and services doesn't actually go up right away to match the new monetary mass, so the prices need to go up because there is more money demanding the same supply of goods and services. So our egg price will also go up at that point. Now, this is how much the global M2 money supply increased in the past few years. We can see here that since 2017, 10 years ago, the actual money mass doubled, so any inflation reported of 2%, 4%, 8% or whatever number is presented on TV is not even reflecting the surface of the problem. And of course, a problem never comes alone, introducing the Cantillon effect, which describes the money flow in the economy. When new money is printed, whoever is closest to the printer has early access to the new money. Basically, they can buy the egg at 25 cents because prices haven't yet started to rise. Actually, instead they buy assets at the current prices, then the prices slowly start to grow and the inflation number is presented as the problem. People get upset and their wages are slowly indexed to inflation, but taking a long time, and in the end, they can also purchase the assets with the new money they got, but of course at the higher price. What is interesting is that when assets go up, they usually go up more than the actual factor of increase in the money supply, because the pendulum usually swings more because people fear inflation and want to protect themselves with assets. They start paying more than they are worth right now because they assume that prices will grow anyways in the future, like it did in the past. Now, enough with the bad news. Let's see what we can do about it. Let's conclude with hopefully some helpful lessons for today. First, you need to understand the difference between the inflation number and the M2 money supply number. Usually, good employers index the salary with inflation, but try, if possible, to negotiate your salary increase by the meager number, which, unsurprisingly, is usually the M2 money supply. The same if you have a business and reprice the goods every year, try to keep the margin the same. Secondly, the printed inflation is useful when investing in that some investors are tracking it religiously and make investment decisions based on it, similar to a rain dance or the technical analysis, sometimes holding true because some people use it and try to front run the trades based on the patterns they quote-unquote see. Third, remember that everybody, including you, has a personal inflation number. The basket is not the same for everyone and it can vary widely. Try to understand yours and make sure a few time big purchases can offset a lot of smaller ones. Like if you buy a house or a car at a discount, then you can eat all the eggs you want at the higher price, but be careful about your cholesterol levels, please. And last but not least, own assets as a hedge against money printing. This was actually the starting point for the video. I wanted to talk about the K-shaped economy we live in right now and the bigger topic of where to put your money to stay ahead of inflation, but the video ran too long. Hopefully I can tackle this topic next month. Anyways, that's it for today. Thanks for watching until the end, and I hope you like this slightly different concept and find it useful in the future. Please don't forget to like and subscribe. See you next month. Ci vediamo presto.